Now we will move on with the very important part. See, everything is important, but in this, no, this is more important and more beautiful questions are sitting on decommissioning liability. With this, we are done with this standard. Now we will learn certain theoretical aspect of accounting, how the impairment, revaluation, decommissioning liability will be accounted. So decommissioning liability, we understood it. What is decommissioning liability? The day we set up something, if the law imposes any restrictions on us, that look, while you go, you have to clean up and go, set it right and go. On the day until we set up, we don't have any obligation, but we set up, we got into an obligation. So Ind AS 37 comes into picture. Now the initial recognition of when should I recognize decommissioning liability? Initially, the day you set up the asset. So what accounting entry I should pass? The accounting entry will be credited to the provision because it is not a financial liability. It's a liability. Either because decommissioning liability, either I may clean up, I may outsource it to some third party. That is different story. But I have got a liability 8 year or 10 year down the line. So credit I am going to give this. And why did you incur? And without this, is your asset ready for use? Will government say, if you say, no, I am not going to clean up, please help me to set up this thing. Government will never ever permit you to set up the plant. That's why this is my cost which I am going to incur to set up this. But this cost is incurred 10 years down the line. Dismantling, you call it dismantling cost, you call it decommissioning cost, decommissioning liability. You can call it by different names. The crux is something we are going to incur to set everything right into its original state. They may use a beautiful English language and give you some other name also. Now, how do I subsequently recognize? See, since you recognize today the present value of the future cash flows, you have to unwind the discount because today you discounted that obligation, you unwind it, like you have to prepare an amortization schedule, but it's not a financial liability. There's no contractual obligation to pay someone, but you will incur the contractual cash. You incur the cash. Then how do you recognize this asset what you debited? You depreciate it. So you pass the entry depreciation expense account debit to accumulated depreciation. And this finance cost to this. And this is something very similar to what we are going to do in 116 next. Lease account. Some crux is something like this. That's fine. What if the liability is going to change? If things are okay, life is simple, then today you discounted. Every year you pass these two entries. Every year you pass these two entries. One day asset value becomes 0. Provision account debit to bank. Finish. What if the provision is going to change because it is an estimated value? After 4 years you may revise. Now comes the challenge. If our Ind AS has given me only one model, say cost model, I didn't have any problem. Life is very simple. Any changes you prospectively do or whatever it is. My problem comes if what if I would have followed a revaluation model? Because PP would have revalued there. So Ind AS offers two different approaches, and that depends upon accounting depends upon whether you are following cost model or a revaluation model. See, cost model is fairly simple model. What happens in a cost model? There can be two possibilities. PP will be recorded at cost. The liability may increase, like initially you anticipated 100 rupees 10 years down the line, and that present value is say 50 rupees. After 4 years you realized, oh, it is not 100 rupees, it is 150 rupees. And its present value 6 years down the line because you have already covered 4 years. So you will calculate some value. If you have, see, it goes like this. 10 years back, when you started now, 10 years down the line, the cost is 100. At some percentage of discount, which we have initially done, PP calculation discounting we used to do, no? This to say 20 years down the line, 0.826. Its present value came to say 50 rupees. What entry I passed? PP account debit to liability. Then PP I started to depreciate for next 10 years, this 50 divided by 10, 55 rupees. And this unwinding of discounting I started to do. Interest expense, like this will move on and it's going to become 10 lakhs. How many years here? Over 4 years over. Now, at the end of 4th year, you realize what you estimated 4 years back, the 10 year down the line, what you are going to incur, no? That is not 100, it is 120. Now, again, you have to find out the present value of 120. When? Not beginning. 4 year already crossed, no. Right now, at the end of, that means how many years left? 6 years left. Now, you will get one difference. Definitely, since your original cost itself has got changed, there is an increase. If there is an increase, your accounting entry will be again PPE to decommissioning liability, as if you are doing original time. If it is a decrease, decommissioning liability to PPE. It's like a change in the estimate. From that year onwards, since your PP is going to change, depreciation is also going to change prospectively, and your revised amortization schedule is going to come. So that today's balance will get unwinded with whatever you have estimated. Life is simple, no? And the moment you increase the value of PP because of the fall in the liability, did the fair value of the asset also increase? Did the capacity of the asset to earn the cash increased? No, no. So simply one book entry came for the asset without its increase in the cash flow. Check for impairment. Impairment happens, then impairment expense account debit to PP. No, well and good. And credit to PP cannot exceed its book value. Whenever you give credit, no. Sometimes it may so happen that the liability what you incur is more than the value of the benefits. We will discuss what is that scenario in Ind AS 37. That means it becomes your, it's called onerous contracts. Like headache. What benefits you get, no, your expenses are more than that. Now, when you credit to PP, look at its book value, because PP cannot have negative value. No, liability increased means PP also cannot become negative. So max to max PP you will make 0. And if your liability increases more than the cost book value of the PP, then you credit to P&L, expense it to P&L. Oh, sorry, income, because the liability got reduced, no. The liability got reduced, no. Decrease in the liability, income, right? So you take it to P&L. Simple accounting. Easy, no? Then please tell management, go for cost model. Now comes, what if the management has opted for revaluation? Now, PP again same situation comes, you are restating it a revaluation. Now there can be two scenarios, that liability got increased or liability got decreased. If the liability got increased, your accounting entry will be revaluation surplus account debit to decommissioning liability account. Did you see the entry here? Difference? Credit will go to the decommissioning liability because liability got increased. When liability get decreased, debit will come to decommissioning liability. But since if you are stating it the revaluation, then the debit or credit should go to revaluation surplus. Now, if you don't have a revaluation balance, which you would have asked me now, next question, then take that surplus to the P&L. But here there is, see, this problem comes only for this, that there is no balance only, I have revised it. What to do? You take to P&L. What if there is credit comes? Then credit, to any amount of credit you can add as a reserve, no? Like this scenario, any increase you can add to PPE, but decrease is limited to 0. Similarly, when there is an increase, when under revaluation matter, the reversal of revaluation surplus is restricted to the balance. Credit, any amount you can give. And when you debit, see, I use the word called SOCE, not OCI. That means it will eat my balance of the accumulated reserve. But if I am giving a credit, that year OCI reserve I am going to show. So if there is a decrease in the liability excess of the carrying amount of deemed revaluation, and it is considered as a deemed revaluation. So if there is this situation, no, it's called deemed revaluation. And credited immediately to the, okay, 1 minute. If there is a decrease in the liability in excess of the carrying amount of the asset, such excess is treated as a deemed revaluation and credited to P&L account. Any change in the liability would require asset to be tested for impairment. Once the related asset reach the end of the useful life, all the subsequent changes will be recognized in the P&L account. and cost and revaluation model. Unwinding of the discount shall be recognized in the P&L as a finance cost. This explanation is for the first part. Okay, I will change this in your, when I give the book to you. This for the first. Now, second portion on the revaluation of the decommissioning liability, entity acquiring the asset will also assume decommissioning liability. Now, one more problem comes. If any asset is revalued on discounted cash flow basis, there can be two approaches followed by the valuers. One, gross valuation, another is called a net valuation. When the revaluation is going to happen, they will revalue both your decommissioning liability also, because you are following which method now? The revaluation method. Now, when you call valuer, sir, please come and value my asset. And when they value, they follow two approaches. You have to look into the question which approach they follow. It's called a gross valuation or a net valuation. In a gross valuation, they will value the asset separately, they will value the liability separately, and they will give you two different figures, because asset is different, liabilities are different. They are interrelated, but how will you present in the balance sheet? PPE you show on the asset side of the balance sheet, and the decommissioning liability you will show on the non-current liability under the liability side of the balance sheet. So both are different now. So when you do the revaluation, they will revalue and provide you two different figures. Alternatively, they may give you net valuation. They say, sir, see, can you sell only asset without liability? Whoever, so tomorrow you don't want this asset, whoever you're going to transfer, they have to buy along with your liability, no? So what is your valuation of the asset? Asset minus decommissioning liability, because your liability also somebody will take over. See, other thing I can bifurcate. Like suppose I have purchased a car. I have purchased a car by taking a bank loan. Now that car and a bank loan are related. Can I sell the car without selling the bank loan? I can do it. No? I cannot tell the buyer, see, look, I have taken this car by taking a bank loan. So if you take this car, you have to take that bank loan also. Tomorrow you repay that bank loan. Do I sell like that? No, I am able to bifurcate both. Which one? You have taken one car, I will repay. No, it's my responsibility, right? No. Okay, understood. Your point is, if I have pledged it, hypothecated, okay, that I'm not going to talk about. I'm talking about some another case where independently I took a loan, I invested on the car. Yes, hypothecation is correct, because they are interrelated. I connected it. Like this, your, what is that called? Decommissioning liability is an interconnected liability. It's very difficult to remove it. You cannot, if you want to sell, you have to sell that liability also. Followed, no? That is why somebody will do net valuation, where they will deduct liability balance. Now, for the financial reporting purpose, decommissioning liability is a separate liability, not deducted from the asset. See, when you talk about gross block and accumulated depreciation, it is one. Always when you present, no, you from the gross block, you deduct the net accumulated depreciation. Will you do it for decommissioning liability? No, decommissioning asset you show on the asset side, provision you showed on the liability side. Accumulated depreciation you don't show, no. Asset here, accumulated depreciation there, no, you net it off. That's why for accounting purpose they are different. In reality they are one. Somebody cannot buy the asset without buying decommissioning liability. But accounting I will show it separately. That is why, thus if the asset is valued on the net basis, if you give me gross, no headache. If you give me both the gross, no headache. But if you do the revaluation and give me a net back, then liability is added back to the value of the asset, because you did the net, no. So that liability is not counted twice. Okay, I will explain you only one question. See, if I follow the cost model, I will take to PPE. But if I do the revaluation, why do I take it to the revaluation surplus? What is the logic behind it? Asset value remains same, no? Does your, see, liability increase, decrease, is it going to affect the fair value of the assets? No, your earning capacity is different story. Now, why do I take it to revaluation surplus? What is the logic behind it? I'll explain you so that you understand and appreciate why we are doing it. Okay, I'll just go through some theory here, whatever we discussed right now. So this is what we discussed, Changes in the liability. Okay, there is one changes in the liability. In your Ind AS, it is 16. It is separately discussed in Appendix A. If you want to find out this material, why we are doing, what is the logic. Now, Ind AS 16 offers cost model or the revaluation model. So, if it is a cost model, life is very simple. PPE account debit to decommissioning liability. If it fall, decommissioning to PPE. Up to this becomes 0. Then it will go to P&L account. We discussed it. Now, here we always take to the revaluation surplus, not to the PPE. So, only one doubt must come to your mind, sir. If it is a cost model, I will take to PPE. But when revaluation, why do we take to the revaluation surplus? Why not to PPE? I could have taken, no? Why my standard is telling take to revaluation surplus? No, but my liability changed, no. This adjustment we are doing on change of the liability. If I do cost model, my original recognition happens. What entry I'll pass? First time. Asset to liability. That's the first. When subsequently change happens in the liability, if I follow cost model, then same, asset to liability. But if it is revaluation, why revaluation surplus? Okay, there's an underlying logic there. Okay, I will tell you the logic. Okay, see this. First, change in the revaluation surplus arising from it is presented as a separate line item in the balance sheet. Now, is adjusted against the revaluation reserve, change in revaluation surplus. Okay. Now, how do we present? We present it like this: asset, non-current assets, PPE gross block, less accumulated depreciation. This is my net block. This where asset side. Liabilities and equity, liability, non-current liability, provision, other liability, other non-current liability, not even one head called provision for restoration, 20. Now, both the PP are interrelated, but the liability change is not going to affect the fair value for accounting purpose. Now, let us take one scenario. Understand this example. Book value of the PP changes is 80 rupees. Its fair value is 100. And book value of the decommissioning liability is 20. This is whichever year, leave it. From the beginning, it has come now. This has come after depreciation. This has come after unwinding of discount. Now, I will pass, because of there is a revaluation. No? I will pass one accounting entry, PP account debit to revaluation surplus. How much? 20 rupees. Book value is how much? 80. Fair value is 100. No? So, I will do the revaluation. So, 20 rupees came now into my books and I created a revaluation reserve. The liability, say for example, after this, the liability got increased by 2 rupees. So, I will pass the entry PP account debit to decommissioning liability. Say, you wanted PP debit, right? That makes sense to you, not the revaluation surplus. Okay, chalo, for you said, I will pass this entry. But the moment you added increased the value of the PP, did the liabilities, assets fair value changed? What changed here? 20 become 22. Did 100 become 102? No. So, since it remained 100, what is your book value? 100. Because after the evaluation, book value of the PP became 100. Plus 2 you do, 102. What is the fair value? 100. So, 2 is impairment, no? When the impairment comes, what accounting entry you pass? Because suddenly now you have to do for, see, if you don't follow cost, if you follow cost model, you don't have this headache of fair value only, no? You don't need to look for the fair value. So straight away take to PPE to book value, finish, and then test for impairment. But since you are following revaluation model, you create one revaluation surplus and uplift the book value to 100. A change in the liability is not going to change this. So immediately you will recognize one impairment and you pass this entry, impairment to PP. Now only one question I will ask you. What do you do with this impairment? Now first you look, is this revaluation surplus available with me? Available, no? Then you, instead of transferring to the P&L account, in case of revalued assets, it is first adjusted with the revaluation surplus. Previously there was one, I told you, twist can come in the exam. So you pass one accounting entry, revaluation surplus to impairment. Ultimately, what did you pass? It's the same, no? So why you want to take such a big route? Ultimately, you will end up with the revaluation surplus only there. Sorry for the interruption. So are you clear, students? So if anybody asks you, maybe in the interview, wherever, why in case of revaluation model, the increase, I will take not to the asset, you should be able to explain. Okay, let me take the another scenario where there is a decrease. So your book value at revalue, okay, whatever, fair value is 100, because generally you revalue, no? So you have revalued and kept here. Book value of the decommissioning liability and 20 is the status. Now the liability decreases by 3. What entry you pass? Decommissioning liability to PPE. This is what you wanted. In cost, this is what you would have passed. But it is not going to change the fair value. So instantly, you revalue it. Because since you always follow revaluation model, anytime the value changes, you can revalue, no? So once you do the revaluation, what entry you pass? PP to revaluation surplus, OCI, understand? Impairment, you will take the balance from the surplus, but the revaluation upward is going to go through that OCI of the year. To avoid all this series, you will pass decommissioning liability to OCI, simple. This problem doesn't come in the cost model. I hope it's very clear to you why we are doing. Yes, anyhow, not much relevant from one problem is there, for that it is relevant, but academically it's very interesting to know why we take this in the cost model, why we pass this entry, in the revaluation model, why we do pass this entry, because there are two examination questions, one is followed with the cost, another is followed with the revaluation. Second problem with the revaluation is approach, gross approach or a net approach. If gross approach is given, headache is not there. But if at all they say, oh, revaluation net approach is so and so, then the gross PP should be, the liability should be added back. Because I want a gross on the asset side, no. So they have to, if the asset is valued on net basis, we should add it twice. Anyhow, this example not relevant. We'll solve the problem. Question number 23, 23 and 24. 24 is also nuclear, right? Question 24, nuclear power plant, no? Huh? 25, no? Both are important questions. Now, entity has got one nuclear power plant, understand? And a related decommissioning liability. Then obviously, no, you set up one nuclear power plant means you have to clean up. You can't leave it and go. The plant started operating from 1st of April 2011. The plant has got a life of 40 years, or you can say 2001. So up to 2040 it is going to work. The initial cost was 1,20,000, which included an amount of decommissioning liability 10,000. That means 1,10,000 is what you have incurred, cost of production, direct cost, okay, all those things which we started. Plus 10,000 is a decommissioning liability. That also part of that. You remember in the working initially we should do add decommissioning liability also. Now, what is this 10,000? It represents 70,400, which you are going to incur 40 years from now. And its discounted value at 5% is 10,000. They need not have given you this. They could have given you 70,400 I am going to incur. Then they would have given you present value factor. Otherwise, since you have to sit and do 40 times in the calculator. Now, chalo, no headache here. Life is simple. The entity's financial year end 31st March, okay. On 31st March 2011, because we started with 2001. After 10 years, the net present value of the decommissioning liability decreased by 8,000. Now, what was the book value on that day? We don't know, but its book value or NPV or present value of the future cash flow, because we understand that anytime 10,000 or whatever book value is the present value of the future cash flows. It decreased by 8,000. That means my liability got decreased. What entry I'll pass? It's by, no, not to. So I don't know. Whatever is the book value. It got increased by 8,000. What entry I should pass? EBIT to You should ask me that question, no? So now which method of, how do you know? And you read, no, up to here. See, my point is, friends, before you conclude, look for information. What exactly they are asking. Now, yes, you will ask, look for that information. Discount rate didn't change. How the entity will account if they adopt the cost model? Okay, chalo, simple. Write solution. When entity follows cost model, reduction, decommissioning, DCL, I will write DCL, decommissioning liability is adjusted with asset or PPE. Revised book value is depreciated over remaining life. Yeah, we understand it. It's a change in the estimate. On 31st March 2011, there is change for which entity passes below entry. Because they asked you when, how the entity will account for the changes. Why I should go with the start, your amortization schedule, depreciation I am going to do. Let me speak specifically, no. What exactly I am going to do on that day. So what is my accounting entry? Okay, so I will pass this accounting entry. So this is the theory in detail I have written for your exam. So my accounting entry will be provision for DCL to PPE. Now we need a new depreciation after this. Are you clear? Okay, next we will write following after this adjustment. Clear, no? Vishnupriya? After this adjustment, the revised values are as follow. So we will always have draw two columns here. What is my historic cost? We will start from the beginning. This is PPE, this is one DCL. How much is my historic cost? 20. No? When I say historic cost, my opening cost 1,20,000. I will present, no. I will tell so many year depreciation, because if I want a book value right now, have they told me the book value of the depreciation there? PPE. They didn't tell me, no. They didn't tell me what is my liability. They said only liability changed by. So what was the book value on that day before I passed the previous entry? And what is my liability? 10,000. This 10,000 is sitting in this 1,20,000. Less depreciation. How many years? 10 years. Can you tell me what is my depreciation for 10 years? One lakh 20 divided by 40 into 10, 30,000. Now, how what is going to happen to the decommissioning liability? Increase or decrease? Decrease. Liability is going to decrease, or liability is going to increase as the time passes? What is this 10,000? Arey Baba, you have to reach 70,400. No, 40 years down the line. Unwinding of the discount means what? Think, pause for a while before you conclude. This is what you do. Mistake. Simply jump into it. Concluding. Think. What is that? Liability is going to increase or decrease? liability is going to eventually increase, because from 10 it should become 7400, because from 7400 you brought to 10 today. So add unwinding. Can you tell me, students, for next 10 years how much unwinding you do? Will you prepare an amortization schedule? No. Why? Because CCF is not there. If CCF was there, different you can't find out. You have to prepare an amortization schedule. Otherwise, remaining cash flows, present value you should have found out. There are two ways. You start with the amortization schedule top, reach that year, 10th year, or next 30 years, what is your cash flow? It's present value, one and the same. It will reach you to that 10th year book value. So how much is my unwinding of the discount amount? Unwinding means next 10 years. Is it my expense or income? Next 10 years. Am I going to pass any accounting entry? Yes. What is my accounting entry? DCL will be credited. That's why it's going to increase. Debit what? Expense, no. You call it by any name. You call it discount, unwinding, whatever. How much is that amount for next cumulatively for 10 years? That's what I'm asking. Yes, Vidya, how much is that amount for next 6 years? 6 years. Sorry, 10 years. Okay, let me hear everyone. No, everyone. 6,280 something. 15,000. No. Discount for next 10 years. Yes, Vidya. 5,100. Yes, everybody is looking at Kriti now. Have we done this in Ind AS 109? Zero coupon bond. In one of the people, we didn't prepare amortization schedule. Then we did to the power. So my amount will be 10,000 into 10 to the 1.05 to the power 10 minus 10,000. It comes to 6,300. This is my interest every year. If you want me to prepare an amortization schedule, I would have prepared an amortization schedule like this. Okay, I would have written year 1, 2, 3, 4, 5, 6, 10. Opening balance, how much? 10,000. Interest, how much? 5%. Then closing balance. Then that becomes opening balance, 5% interest, closing balance. Like you get this 10th year, how much you are going to get? Something. Now, if I'm asking you, give me this interest balance for all the years. Since there is no cash flow, that's what I'm repeating it. If there was a cash flow, outflow happening in between, you should have prepared one amortization schedule there to figure out what is your unwinding happening. Here you need not sorry? Part you would have paid. No, then your interest is going to change there. In between something would have happened. Life, see, in reality, they give easy life, easy problems. This is a simulation. Now, see, again, understand 109, how much important it is to understand it. Because that acts as a base to you. Oh, liability, present valuation. 116 also we are going to come across this. So, are you clear now? Yes, Vidya, you are clear. What did we do? See, 10,000 is my opening balance. I want next 10-year interest expense because 70,400 I found out its present value and booked 10,000 rupees. This is what we did initially started when we have to calculate the cost of the asset. Because it's a face value, no, it's opening balance. Okay, in my amortization schedule, did I ask you this balance or did I ask you the total value of the interest? Because if you tell me 10,000 into 1.05 to the power 10, you tell me this balance. I didn't want the closing balance, no. So from this balance, you deduct the opening balance, you get the interest for all the years. Perfect? Very clear? Yeah, please ask me. This is a very important question for the exam. You have to practice it thoroughly. Next question will change your understanding. Okay, now what is your, okay, 6,300 happened. If you add, you get the closing balance. Do you want to add it? No, there is one more adjustment coming into picture. What is that adjustment? Reduction in liability. What entry did you pass? So I'm going to add or deduct here PPE. Minus 8,000. Here minus 8,000. So my book balance became 82,000 and 8,300. Now because of this, my depreciation is going to change now. Yes, so next we will write. So how much is the depreciation? Depreciation from 2011-12 onward, how much? Rupees 2733. How did you get? 82,000 divided by 30 years. Because liability got changed. And how much is the interest expense next year? Interest expense next year will be 8,300 into 5%, 415. Okay, this is what they have done in the study material also. Follow? And see, you may ask me, sir, discount rate is not going to change, but the question is telling the discount rate didn't change. Anyhow, don't think much about it. Are you clear about this question? Yes, so next question, another one RTP question. Company X built a new plant that was brought into use on 1st of April 2011. The cost to construct the plant is 1.5 crore. Estimated useful life is 20 and they use the cost model. Good. The initial carrying amount included 10 lakh rupees decommissioning, which was determined at a discount rate of 10%, which is already a present value, because this is sitting as part of 1.5 crores. On 31st March 2012, at the end of the first year, company X remeasured the provision for decommissioning to be 13 lakhs. Now provide the necessary entries at the end of 2012 for recording of the depreciation and decommissioning liability. Yes, friends, can you please pause the video? You have to just pass the entries, journal entries, at the end of 31st March 2012. Only 1 year over. Simple, no? Question. Yes, please pause the video and do the entries. Let us compare the answer. Yes, friends, so we'll compare the answer. And the moment you realize that I have to just give the journal entry finished like this. But if you end up doing working and all, no, you spend more time, students. See, that's what you should be doing in examination also. Figure out what they ask you. Do they ask me theory? Do they ask me the calculations, computations, analysis, advisors? Okay, the first journal entry is very simple. I will charge depreciation to accumulated depreciation bar plant. Whatever, you could have changed, you could have done whatever it is. 7.5 lakhs. You would have done this entry. Did you pass this entry so far? Why? You focused only on the decommissioning liability. Yeah, on 31st, are you not charging depreciation on the asset which you purchased on the 1st of April? 1 year over, no? You pass single entry. Okay, anyhow, you can separate it. No problem. You passed, no? See, is this entry depreciation debited? 7.5 lakhs. Okay. Second is interest expense to provision decommissioning liability. Then unwinding, is it not going? Are you not going to do it? Have we not done in the previous question? We didn't pass the entry. That 6,300 whatever, we calculated it and showed, oh, it's my liability balance has got increased. How it increased? You must have passed one entry, no? Finance cost account debit to provision. Then the third, plant to provision for decommissioning liability, because there's an increase. But increase how much? 13. But what was your book value? It is 10 plus this finance cost unwinding. So 2. Now comes one beautiful assumption. Did the fair value change? Question is totally silent. So since my standard says, look, when you increase the plant value, test for impairment. So if you make an assumption that They didn't do it. If you make an assumption that a fair value has not changed, then you will pass immediately one more entry, impairment account debit to PPE. Fair value didn't change, no. If it left for assumption, anyhow, that is your extra. You can, if you're not going to get anything if this is not part of the scheme. Sorry? Doubter, ask me. Depreciation debit to accumulated depreciation. You would have done that. Okay, no problem. They also told, no, in the bracket they have given plant. No? Means they could have, you could have transferred to the accumulated depreciation, because ultimately when it comes to the presentation, accumulated depreciation is always presented net of it. That means you will transfer this to plant now. Literally one more entry comes, accumulated depreciation to plant. That's why they said plant. Okay, that doesn't matter. Present value of, no, it increased 13 lakhs together. No, that means it's actually a present value only. Remeasures the provision to 13 lakhs. See, first of all, this 10 lakh is payable when? 20 years down the line. How much? I don't know, maybe 26 lakhs. Its present value is 10 lakhs. Now you spent how many years? 1 year. Now 25 years remain now. So 19 years remain. Now its value increased to, say, for example, 29 lakhs. That is 13. Followed, no? So the present value of whatever future you are going to spend, that present value only got changed. In exam, they may twist it. Like in the previous question, 70,400, its present value is 10,000 rupees. And what they plan to play, no, that became 82,600. And they will give you one present value table at the bottom. This is conceptual. What you should do now? Understood the question? Question is nuclear power plant. 10,000 is my present value, which is going to be incurred 40 years down the line. 10 year finished. And that amount got changed to 82,600. Then what you will do? Go to the present value factor, discount it to 30 years. Find out the present value. Then find out the book value by unwinding this discount for next 10 years. This difference is the change. Fall or decrease. In and out you should be knowing what is that, how it is coming from. You understood my point here? Yes. That's it. Now we will come to the most important, in fact the crux of this chapter lies in this particular problem. It has not come, I don't know whether it has come or not, but you have to understand it very clean, very clearly, practice it very thoroughly. I don't know whether in the previous attempt this question has come or not. Question number 25. See, this question never came in the previous attempt. Never ever in all the 11 attempts. It may come for your attempt. Initial days, no? Because there is some transition is happening. So they may ask you this question. Entity has got a nuclear power plant and related decommissioning liability. The nuclear power plant started on 1st of April 2001. 40 years of life. 1,20,000 is the cost. 10,000 is the decommissioning liability. 70,400 which will be discounted at 5% 40 years from now. It is the same story. Entity's financial year end 31st March. Now the market based discounted cash flow valuation of 1,15,000 is obtained. Oh, that means you got fair value of this assets. When 31st March 2004, 3 years down the line, or 14 you can also say, doesn't matter. In exam you will never get X, you get the proper dates only. That means within next 4 years, 31st March 2004, that means 1st April 2001, 2, 3, 4, 3 years. You got one revaluation done, that this must be revalued. This valuation is after deduction of an allowance of rupees 11,600 for decommissioning cost. Which method of revaluation? Net method. So you have to add the, if you want to find out the fair value of the gross block, add this and find out the gross block, which represents no change in the original. That means Liability didn't change. You applied a fair value, revaluation model for the asset, and the evaluator gave you the fair value. What is that? 1,15,000 net. But you wanted a gross because you present both separately. Add this 11,600 to 115. You say 1,26,600. Finish. After inviting 3 years. That means this is what happens in the first 3 years. On 31st March 2015, that means next one more year. That year finished, year end finished. Entity estimates as a result of technological advancements, the present value of the decommissioning liability, which is due how many years from now? 36 years from now, is decreased by, okay, straight away one amount they give, like 8,000, this is 5,000. The entity decides that the full valuation of the asset is needed again on 31st March 2015. So, second year what happened? Again two things happen. One, your liability changes, and again you do the revaluation. Generally you do for 3 years, but this time you decided, okay, let me do revaluation again. In order to ensure the carrying amount does not differ materially from the asset value, asset is now valued 1,07,000 net. Add back. What is my book value? To carry out now. Previously they told me. Can I calculate this number? 11,600. How did I get this? How did I get this? Can I check? 10,000 into 1.05 to the power 3. Is it going to give me 1.05 into equal to into 10,000? 11,596, which is 11,600. That means this difference between 10,000 and 11,600 is the interest expense for 3 years. But here they told me, they need not have told me also. I added it back. But when they gave me 1,07,000, I should have added book value of the decommissioning liability, which they didn't tell me. So I have to calculate it after changing the liability, add it to this liability for a gross valuation, and then do the revaluation. Nice question. Beautiful question. How the entity is going to account the above changes if it adopts the revaluation model? In the new scheme, they said examine, look into the pieces, because there are a lot of components sitting there. One is decommissioning liability changes, revaluation you are going to do, again you do the revaluation. So how we are going to account the changes in the liability if it adopts revaluation model? Okay, right, working of the balance. First thing, see, if you open the study material, so many things are there. You have to take risk by following my method, okay? I don't know really, but you can do it very fast if we follow my method. I cannot guarantee full marks, but if you want full marks, then you have to practice ICA method. But do my practice first. Then if you want to, you practice ICA, open study material, and do the way they have to. Okay, working balances. You write working of balance of PPE and DCL. So we'll have the balances first. I start with the historic cost. How much? Same 1,20,000, 10,000. What is my depreciation for 3 years? 1,20,000 by 40 into 3. 30,000. Oh, sorry, 9,000. 30 was in the previous, no? 10-year depreciation. 9,000. How much is my add unwinding of discount? 11,600 minus 10,000. Don't need to calculate again, because you will calculate, you will get different number there. 1,600. So, book value before revaluation 1,11,000, 11,600. Perfect, no? Very clean. You understood now how the valuation moved. Now, did you make a revaluation gain or revaluation loss? Gain. If it is gain, how much? See, one thing is you can say straight away revalued amount. That you have to do if you want to calculate the balance of gain or loss. But we are not doing it. We are going to say add revaluation gain. Can you do the working in the bracket and tell me how much is my revaluation gain? Yes, others? Question is clear? Previously what I used to do, revaluation amount only I used to write here, less revaluation amount. Balance I used to get the book value, revaluation gain or loss. In this case, that revaluation amount only I am going to add it so that I will get the book value. See, you got the carrying amount. You did the revaluation. Did you make a gain or loss? Gain. That's what I am asking. How much? That's what I am asking you. Yes, Vidya. How much, Kriti? You made a revaluation, no? You made at the end of 31st March 2013, right? Whatever, after 3 years down the line. You made a revaluation. Did you made a revaluation gain or loss? Gain. How much? 15,600. How? You add this liability balance what you got here, no, 11,600, which they only gave, add it to the net value, because this is net valuation. This is net, no, they only told. What my appendix says of Ind AS 116, if they give you net, add it. And from this you deduct the book value, you get 15,600. This becomes the book value of the assets on 31st March 2013. And your assumption is you must have passed one depreciation elimination entry, not gross block restatement. Yes, Vidya, are you clear? Why we are doing this 15,600? No, at that time, did this change? No, that's why I take only 11,600. But next year I will face a problem there. That's why they didn't tell you the balance, because that's going to change. So what I will do next year? Less depreciation for 2014-15 or 2004-5, whatever it is. How much is my depreciation next year? Yes, did everyone complete these two numbers? Yes, can you tell me the depreciation next year? I should start depreciation, no? Yes, students, see, online students, I am giving you time also because I am going all off with you only. So I hope you also should calculate by that time. Yes? Yes, Vidya. What is my depreciation next year? Okay, how do you get the depreciation? See, have we not done previously, change in the estimates and all? Simple. There is nothing, no. It's just a revaluation. So you adopt which method of accounting? Depreciation elimination. That means you eliminate all the accumulated balances. You got a book value 1,26,600 divided by how many years? 37 years. So you get 3,422 as the book value. Sorry, what is that called? Depreciation. Are you not going to add unwinding? How much? I want this number. You understood, no? How it goes? Yes, Vidya, what is your doubt? You have got some clean, no? Very clean. So please discuss, take this opportunity to discuss with me. So what is my unwinding of the discount? Yes, Prithvi here, unwinding of the discount. 1 into 1.05 or 0.05. I want a discounting. I want to know what is the amount here. So I is telling 580. Yes, it is 580. See, now your imagination should run more than what you are doing here. Your mind should be very clear what is happening. Schedule and all, you should be able to see it. Then you will excel any examination. 3 hours is just like you will do it, because your mind is working very fast. See, when there is a tabla player, more than his hand, his mind is working fast, no? Or piano player is there, guitar player is there. Everybody will work from their mind. Mind will give the instruction to the hand. So focus on your thinking process. Now you got the closing. Okay. Now what happened there? Reduction in the liability happened. What entry you are going to pass on reduction of the liability? Did they tell you the reduction value? Did they told you the reduction value? Now next year reduction happened. No. What is the value it got reduced by? 5,000. What accounting entry you are going to pass? Okay, I will help you. Reduction happened, no? Debit decommissioning liability. Credit what? Revaluation OCI. That means you will reduce the liability but will not touch the PPE. When it was cost model, you deducted both the places. 8,000, 8,000. Here revaluation, I told you why also we are doing that. We will take to OCI. OCI will not come in the PPE. No, it's a different item only. Now what you do? Revaluation you do now again. So if you don't do this working, no, and if you open study material, even a perfect clarity person will get confused what they have done there. After this working, you go explain now what you have done. Simple. You may not get full marks, but 80 to 90% marks, so definitely you score. Enough now for the time you are going to spend. Accuracy is important, no? With numbers what you quote there. Okay, now tell me, this is my book value. Upward revaluation or downward revaluation happened? Whatever. Did I incur revaluation gain or loss? Gain. How much is my gain, or if loss, how much is the loss? 8,000. 999 gain. Loss, how much loss? Yes, Vidya. Did I made a gain or a loss? It's consuming me so much time. Huh? Loss. Same amount, no? How much? 8,999. How did you get? How did you get? For this balance, okay, this is the revaluation amount, but this is a net basis. For this net, they didn't tell you this time. Take this balance, add it. You got the total value. Minus 1,23,000. Yeah, you got a loss. Now what do you do with this loss? What accounting entry will pass for this loss? How much? Yes, how much? How much? Is this sufficient revaluation surplus available? So what entry will pass? Revaluation surplus to PPE. You will not take to P&L account. Will you take to P&L? How can you take? Because already surplus is sitting, no, 15,600. Some revaluation surplus is there. Out of 15,600, you took only 5,000. Still 10,000 somewhere balance is there. So it's sufficient. So carrying amount is this. Okay. I hope we are very clear. Now we'll do working note number 2. Revaluation surplus balance. Yes, students, so please pause the video and get me the balance of the revaluation surplus. Okay, so 11,602, 1,602. But majority who? 11,602, no? See, first is the balance, no confusion. See, when there is a decrease in the liability, it is the addition to the reserve, no? You must have deducted it instead of adding. That's what I'm telling you. See, this add and deduction in FR comes from the journal entry debit or credit for this balance ledger. This is revaluation surplus is a ledger balance. Whether you're going to add it or deduct it, transaction cost, I'm going to add it or deduct it. That comes from the journal entry debit credit. So you deduct the revaluation surplus here, you get 11,602. See, you should not confuse here. You have got confusion. Should I add or deduct? Think journally. I told you, no, it's like a lamp in the darkness. You're not clear, Prithvi? What entry you passed first time? PPE to revaluation surplus. You gave a credit. When the decommissioning liability reduced, what entry did you pass? See, if you mathematically added, it's a procedural knowledge. Oh, I have to liability reduces, I will do it here. But understanding the second leg, your accounting entry was decommissioning liability account debit because liability got reduced. To OCI, no. Again credit. And then third, revaluation loss you incurred. Revaluation surplus to PP debit. That's why add less. To revaluation surplus, no? You only told me. Under revaluation model, what entry I need to pass? You only told me, right? Perfect. Nice. Okay. Yes, students, so please pause the video and tell me the balance of retained earnings. Retained earnings must be having some balance, no? And I hope online students, you must have got the balances, whatever we discussed previously or understood. First of all, did you ask me why we are working out these balances and all? Question is silent. They are asking extract of the balance sheet as on 31st March. So when they ask you extract, you need the balance, closing balance of the PPE, you need the closing balance of that liability, you need the retained earnings, you need a revaluation surplus balance. How do you present all these things? That's why we are doing all these calculations. Okay, students. So if you are not able to figure out, again, my assessment about you is you are thinking very technically, procedurally. You are looking at a procedure. Okay, this is this. You look at only that number. You don't know the meaning of that number. This is my assessment. Because if you know, if you go think like an accountant, imagine like an accountant, just think, okay, this is my working. Which all the items will go to P&L account? That one intimation is sufficient for you to figure out the balance now. Because you know the items which go to P&L will be reflected in the retained earnings. Now tell me, in your working, which all the items went to P&L account? Depreciation went. Unwinding of the discount comes as an interest expense. Interest expense will go. So for the first 3 years, 9,000 plus 1,600 went. Then depreciation and discount for the next year also went same way. Then that's it, 14,000. Other than that, tell me which item is there which will go to P&L? All other items went to OCI, no. The reason is you do the accounting on revaluation basis. Otherwise, everything you would have found out in the P&L only there, which would have hit your retained earnings. Now the revaluation surplus is sitting. Now asset you sell, you will transfer it to retained earnings. This is concept. If you are understanding all these individual components, how it is moving, where it is sitting, and you are able to think like an accountant, okay, this balances will go to pay. Papa, it's a very simple, no, Papa. Only balance sheet, right? Along with balance sheet, one P&L is given. That relationship, though, you know. Journal entries, what you have to be. And tell me, am I deviating from journal entries? Everything I am telling you from journal entry only. Even though it's a small first year PUC or a super high Vidwan, whatever of accounting, both talks journal entry, no. Calculations come, debit, credit, plus, minus come from journal entry. Figure out journal entries. Life is simple. Done. Now we will start the solution. This is what? This is working notes. Okay, start accounting. 1. Valuation approach. An entity acquiring asset generally assume DCL. So any entity which acquires the asset, say nuclear power plant, will acquire the liability also. If such asset is valued using DCF, discounted cash flow, there are two approaches. One, gross, second, net. Where DCL is deducted. So I'll write in the short. So this is called a valuation approach. I'll explain it again. In valuation approach, you say that, look, an entity acquiring a nuclear asset, nuclear entity, will assume liability. Whenever you are going to value that asset, there are two approaches. And if you responded, one is a gross value where DCL is not deducted. Another is a net valuation where the DCL is deducted. This is you start with explaining. Next, total value of the asset. What is the total value? Second, total value. For FR, financial reporting, DCL is separate liability. Thus, if asset is valued on net basis, we need to add DCL to valuation. Why we are doing all these things? We are explaining it. So first thing is, see, we say that there is an asset can be subject to two types of valuation. Now, if at all net valuation is adopted, the decommissioning liability balance will be added to it, which we did in our working. Somebody looking at our working, they may not understand what you have done there. What is the added decommissioning liability? One leg is sitting here, another leg is revaluation surplus. So you have to explain that. Okay, so now you explain like this: total valuation of the asset, revaluation surplus. Third, revaluation surplus on change of DCL. If the revaluation surplus, if the liability is going to change, what is going to happen? On 31st March 2015, DCL decreased by rupees 5,000. This is adjusted with revaluation surplus. With below entry. Because you don't see in the examination, question is today examine something, but they may say, look, on the date of accounting, how do you do it? I will not start from the beginning. My beginning happens only on the day when the liability has changed. So my entry is decommissioning liability account debit to revaluation surplus OCI. Have we not done the same thing in the previous 8,000, 8,000? So this is the theory we write. On 31st March, decommissioning liability increase, decrease. We are going to adjust to OCI. So we'll pass this entry. Yes, we are done with the 31st March. That's it. Now subsequently, what is going to happen? Point number 4. Subsequent revaluation. As on 31st March 2015, entity revised assets value at rupees 1,07,000, net of DCL rupees 7,200. We will talk about the last year now, for which we have done the working. Therefore, the gross value is rupees 1,14,200. Now what happens? Revaluation loss or gain? This result into what happens? Revaluation loss of rupees 8,998. Look at the first working. In fact, what we are trying to do here, we are trying to explain the first working, starting from, not from the beginning. We are starting from the reduction in the decommissioning liability. Or first thing what happened, which incident happened first? Revaluation, no? So if you look into your theory, what we have written, we started to explain, look, revaluation. From there we started. Gross approach, net approach. Then came what? Decrease in the liability. We passed that journal entry. Then we went to the again second year. Again revaluation happened. We explained the revaluation. That year no decrease. So we have got the revaluation loss of this particular thing. So what entry we were going to pass? Below entry will be passed. Can you tell me the entry? Accumulated depreciation account debit 3422 to PPE gross block. Revaluation surplus account debit 8998 to PPE. Are you clear? So first of all, when we did the first revaluation, did we pass this accumulated depreciation account debit? Did we pass? No. Why? Because first thing we started with the change in the liability there. So we passed only that entry. If you want, you can pass that. You can tell that cumulative so much depreciation was there. I have reversed it. So we are looking into the change in the liability and the subsequent revaluation only here. So revaluation surplus to loss block. Now they asked you the balance sheet extract. Amounts included in the balance sheet. So amount in balance sheet. So you have to write here two column. 31st March 15, 31st March 14, 14, 15. What is my PPE? Can you tell me, students, on 31st March 2014? Hmm? 126,600. And your assumption, all the accumulated depreciation removed. Otherwise, you would have kept one presentation there. 31st March 2016, 1 lakh 14,180. Correct? Then what is your decommissioning liability? Again, I should present it. See, they didn't ask me the extract. If they would have asked me extract, I should have given asset, PP, that way. Liability, non-current liability. They asked me just the balances. 11,600 negative balance. This becomes 7,180. What is my retained earnings? On 31st March 2014. That is when? That is when? That is when? The 14,602 is when? 15, no. My question is how much is on 31st March? 10,600. There, in that question only there was a breakup, no? And revaluation surplus? 31st March 2015? I will tell you, 11,602. What is my revaluation surplus on 31st March 2014? $15,600. Nice question. Retained earnings? Sorry? P&L, all, what does it includes? Depreciation and finance cost. So, first 4 years, 3 years depreciation and finance cost is 10,600, and the next year's is this addition. If you look into the working of that, we get two workings only. There are only two things. Cumulative and this. This is not an extract, no. If it was an extract, then I would have presented that way. Not even reserves and surplus. In Ind AS, we don't speak called reserves and surplus. It is accounting standard. In Ind AS, the heading starts with the equity and liability, equity, equity share capital, other equity. Under other equity, retained earnings is going to come. That's the, if you proper extract they ask. If they ask you the balances, you are going to write this. Extract is different. Ah. Reserves and surplus, no, not there. You are going to use the word called other equity. Under other equity, you will go to different balances. This is what we discussed on day one. No, I showed you. I want you to remember, anyhow, no problem. In the moment we do the consolidation chapter, every problem we have to do that. Sit and do. So you will get used to it. Each item, no, and that to analysis of the financial statement, you have to draft one financial statement as per Ind AS. By that time, you will become expert. So we'll move on to the last question. Yes, sir. So we'll move on to the question 26. H Limited purchased an item of PP costing 100 million rupee, 10 crore, has got a useful life of 10 years. Okay. The entity has contractual decommissioning and site, it may also call site restoration obligation. One more new word. Estimated at 5 million, 50 lakh rupees, which is going to be incurred at the end of 10th year, and the discount rate is 8%. Now what they have given me? 50 lakh 10 year down the line, I have to find out figure out the present value. The company follows the straight line method for depreciation. Great relief for you that they use a cost model for your accounting of the PP. So now decommissioning liability headache is not there. Any changes happening, you adjust then and there, it shows to the PP only. Otherwise, revaluation surplus would have come into picture. Now the determine, and not just revaluation surplus, revaluation is also going to happen now. Two challenges, not even one challenge. Determine the carrying value, means what? Book value of the PP and decommissioning liability at each year end. Simple, no? At the end of the every year, what is my book value? When there is no change in the expected decommissioning expense, simply waste of time for you. They are going to consume your time by doing this. Expected timing is not going to change. At the end of the 4th year, that entity estimated cash flows on decommissioning and site restoration to be incurred at the end of the 8th year is 8 million. I was giving some time back one example, no? Generally, they will tell now suddenly they will say, no, it's not 70,400, it is 82,600. Already 4 years have been passed. This is this. Now, what I estimated 4 years back, that 10 years down the line, what amount will be? That amount is going to change, but already I have covered how many? 4 years. In place of 5 million, 8 millions. Determine in case 2 how to account for the changes. That I should tell. So what should I do? Step 1. Present value. Okay, right. Present value of the decommissioning liability. Present value of DCL is equal to 5 million into 0.4632. 2.32 million. We'll write in millions only. Big number. First of all, they are wasting your time there by asking you 10-year balance and all. And if you continue to do in lakhs, no, you'll spend time there. Let us do in million. They are given in million, no. The entity will recognize unwinding of discount as finance cost. So write the story there that the unwinding of the discount will be recognized as a finance cost. Now, do you want free mark? Nothing is free, okay? This free is at the cost of your time. Case 1, no change in the liability. We'll do it together. Right here, opening PP, depreciation, closing PP. Opening decommissioning liability, unwinding of the discount, closing decommissioning. Previously, we used to do it as a next to each other, right? Column, only one column we have to add. Now we have to present like an amortization statement now. Because they asked me the book value at the end of the year. Say I'll write 1, 2, 3, like this, 4, 5, like this, I'll go up to 10. Next 10 years I had to present. Maybe in the exam they may give you only 5 years, God knows. How much is your opening balance of PP? And how much is my opening balance of PPE? 100. Plus 5. How much? 102.32. See, all the question, decommissioning liability was already part of the value they used to give. This time they have separated it. Concept again. You miss it, gone. No. Whatever free of cost you used to get, that also gone if you start with 100 there. Or 105. See, you have to, and you have to know that. Is it part or is it not part? This is simple. How much? 10.23. Maybe last year you will adjust. Closing PPE 92.08. 92.08. This will become 81.85. This will become 71.62. So you just write for 3 years. Huh? I'll ask you, what is my opening liability, decommissioning liability? 2.32. Unwinding is going to happen at 8%. 0.19. 2.50. 2.50 is going to become 0.22, 2.70. 2.70 is going to become 0.22, 2.92. Like this, you will present one liability statement and you will present decommissioning statement. Okay, just write at the end total 102.32, 2.68. Yes, this is first part of the question. Okay, we'll go back to the question. H Limited purchased an item costing 100, which is useful life. Entity has a contractual obligation, but have they incurred? They have not told. No, if you observe previous two questions, this includes. They told you very specifically. Like this, you remember yesterday we did one material cost related question. You make an assumption. If the question is very silent here, included or not included, but with the assumption. If we don't do assumption, we may lose the marks for assumption, and I really don't know their marking scheme, whether they take 1 mark or they will totally ignore this. Assumptions are in. Yeah, we can take it that way. Okay, is it clear, students? Yes, now we will move on to the second scenario, no change. Sorry, with the change. Case B. Change in liability. Working note number 2. How much is the change in amount of change? Yes, students. So please pause the video and tell me the amount of change, because previous two questions they've put in one spoon whatever was the amount into your mouth straight away. 5,000 rupees, 8,000 rupees. This question they didn't tell you. So we have to calculate, no? Yes, students. So please pause the video and calculate. Yes, students, very nice. Happy to know that you are telling me the correct amount. It is revised liability at the end of 4th year is nothing but, see, this is what they used to do. Every time they used to tell you how much increased by, but how that amount was calculated. If this question was not there, that comes as a conceptual question in the exam. At least now you know now. 8 million is going to change, but you already spent 4 years. So present value factor, discount factor didn't change. If they tell you discount factor changes, it is going to change now. Its present value at 6 years. What if in the examination they say the discount factor also got changed by 9%? It's going to change 9. You have to take a present value factor with 9 into this minus your existing book value was 3.15. How did you get 3.15? Fourth year balance. You compare this with the increase and say that look 1.89. Are you clear? Now what accounting entry you will pass for this? Easy. Okay, easy, no? PP. Okay, so but you should try it, no? Since entity follow cost model, 1.89 is added to PP. So your entry will be PP debit to DCL. 1.89 million. They asked you, second part of the first question is how much, what you will do, what is the closing balance at the end of the every year. Then second part of the question, look, there is some change happened. How do you account that change? I will account the change like this. Then again, what is your revised amortization schedule, revised balances? Followed, no? What do I need to calculate the revised? I need a revised discount, no? Revised interest rate. Sorry, revised depreciation and revised discounting, what is that, unwinding of the discount. So, revised depreciation. How much is my revised depreciation? Working note 1. Revised depreciation. Depreciation is equal to, can you tell me the revised depreciation, students? Very easy thing. Going forward, see how much I am charging right now. 10.23. Going forward, how much I am going to charge? How much I will charge going forward? 10.54, whatever. So how 61.39 is the book value after 4 years of depreciation. Add 1.89 to it. Why did you add? Because journal entry you debited it. Divided by the balance life. What if they say the revised balance is revised? Then this becomes very complicated question actually. Better don't touch it. That's why by looking at the question you should know, this question came as it is or they twisted it. The problem is what happened, no? Everything is same. They revise one life there. Which is, you remember that in study material they have not done that way. Now problem is if you touch this, no? At this point of time you get stuck. Because you have never done it. I'm telling not to do it right now. I'm just telling define your priority. Do it later. If you see some adjustments and you feel that, okay, your mind moves fast, no? You can't figure out the adjustment, what to do, don't touch it, I'm in confusion. Yes, now we will do the new case 2. Very simple. Year what? Which year it is? So it will be very important, no? 5. Very important. Because already we know how many years we have happened, which values we have taken. Year 5. What is my balance? $28. Depreciation we already calculated. Closing balance is 52.73. Decommissioning liability balance. Yes, Kriti, decommissioning liability balance. $5.04. Unwinding will be happening at 8%. They didn't change their interest, not even the date, year, 0.40 and 5.44. Yes, this one line defines the pattern for the subsequent thing. If you miss here, then waste of time actually working subsequently. First thing you figure out correctly, because this is your slipping point and this is your slipping point here. And this comes from your adjustments, previous adjustment. Then you go on continuing. I'm not interested in what you do subsequently because there is a procedural thing. This is conceptual, what you write here. Yes, students, so you can pause the video and you can continue and complete it. See, now, done? Yes, write one note there. Since the entity has adjusted the increase in the decommissioning liability, what they need to do now? Test for impairment. Write a note always, because your fair value didn't increase, no. All adjustment happened there because of an accounting adjustment. Accounting adjustment is not going to touch your fair values. Fair value is a market based. Yes, so we will move on to the theory questions now. Okay, so we are done with the practical questions here. So we'll look into the theory questions. There are some few theory questions also, which is highly probable. See students, now you may be, we are done with the second chapter here. Okay, good, no? In 2 days only. First standard took me weeks. Like this, it will move on, don't worry. But importantly, if you see, there is one element of complexity, correct, no? So much things. But what I'm telling, I have got, if you want, I have got so many other questions also. Beautiful question, knowledge enriching questions, so many questions. But see, what I'm giving you is my judgment with the 6 years of experience. Okay, my guess. High probable questions only I have given, high probable questions only I am discussing. So practice whatever questions we are doing in the class thoroughly. After you finish all the, not even this, you have to move to the other subject also. It's not your only one FR. You have to complete there. Look for the priority questions, solve it, get the confidence. Then time permits, no, come back to my FR, additional questions which I will give you at the end, no, theory, for academic knowledge and all, you study then. But whatever questions I am giving you, okay, please practice it thoroughly. 2, 3, 4 times you should do it. You should understand all the balances, what is going to happen, where it's going to come from. Okay, so we'll move on to the theory questions.